Alright, what's up guys? Back in another video. In today's video, I want to talk about the best investment strategy for beginners and billionaires. So to get straight into it, we're going to be talking about the Boglehead investment strategy. So to basically sum it up, the Boglehead investment strategy is one of the simplest, most evidence-backed, and effective ways to build long-term wealth. I'm talking no stock picking, no market timing, no stress, just long-term results. So before I get into a little more breaking it down individually, I want to talk a little bit about the history of the Boglehead investment strategy, just so that way you guys understand a little more about what it is. So the Boglehead philosophy is named after John Bogle, the founder of Vanguard and the inventor of the index fund. He basically believed that most investors fail not because of the market, but because of fees, complexity, and emotional decisions, right? Now, to avoid all of this, in the air kind of thoughts that just kind of tend to throw people off, especially when it comes to investing. Basically, what he did is he had 5 core principles that he followed to make sure that he'd stay in line with his investment strategy. So, number 1 being invest in broad market index funds. Own the entire market, not individual company stocks, right? Number 2, keep cost extremely low. Best thing to do is avoid high fee funds and unnecessary advisors. And number 3, basically just keeping it diverse, not too diverse, simply just stick to the US, international, and bond markets. And then number 4, stick to a long-term plan. No market timings, no day trading, none of that stuff. If you're going to do that, do it on your own time. For this in specific, we're keeping it long-term, 20, 30, 40, 50 years into the future, especially if you're young. Now, number 5, ignore the noise. This is my biggest personal belief on this. I personally do a lot of this. I have people in my life that tell me to buy all kinds of things, whether it just be anything from meme coins to you should day trade. I don't listen to any of it, right? I don't listen to any of the news. I don't listen to any of the hype. I don't try to predict the market. I just keep it simple. Now, I know this approach is very boring, but that's kind of the whole point, right? If you keep it simplistic, you keep it boring, you're going to see the results without having any of the risk. So now that we've talked about his 5 core principles to just kind of keep him on track, let's talk a little bit more about why it works. So number 1 is you don't need to beat the market. We talked about that with his core principles. You do not need to beat the market. You see a lot of people trying to just get in at the right time, get in at a crash or sell at a high, whatever, right? Trying to pick winners sounds smart. It does. But most people underperform the overall market. Even professional fund managers fail to beat the S&P 500 over the long term. And number 2, a big one for me in specific, is index funds are cheap. I know a lot of people talk about not being able to invest because they don't have enough money, but I'll tell you right now, the average actively managed mutual fund charges over 1%. Meanwhile, a Boglehead styled index fund is as low as 0.3% to 0.10%. Now, I know it might not seem like a huge difference, 1% to 0.3 to 0.10, but I can tell you right now, the difference of compound interest over the decades can cost you way more than you think. Now, number 3, I've talked a lot about this with people in my personal life, especially, is it removes the emotion from investing. I know a lot of people who are just trying to take their money, throw it into something, and pray that it's going to return 5 to 10% in like a night, right? But Bogleheads, they don't chase trends. They don't panic during crashes, right? They just keep investing through the good markets and the bad. And historically, that discipline is what drives long-term returns. Like, look at this most recent crash, right? Trump did the whole tariffs thing. The market went down. Hell, I even made a video talking about it was a good time to get into the market. I ended up being right. Not saying I'm always going to be right, and I don't like to predict it, but I felt the need to just make that video for anyone who just had some cash on the side, who was just ready to time the market, even though I hate doing that. It's just, if you would have threw it in right there, you would have made some money. But like I said, I didn't even personally throw that much in. I threw as much in as I've been throwing in for the past 2 years, right? I didn't throw any excessive amounts. I just stuck to my script and I just put the normal amount that I put in every month. So for the last part of this section here, just kind of talking about why it works, is number 4, simplicity beats complexity. I know we talked a little bit about just kind of just trying to make it super complex and buying 500 different things and just praying that, because I'm diversified, it'll go well. Not always true. Studies show that more complex a portfolio gets, the more likely it is to be underperforming due to poor behavior and higher fees. The Boglehead strategy is easy to follow, and it is so hard to screw up. I mean, when you really think about it, you're just throwing a single set amount in, every month or every 2 months if you can, every week if you can, really, just throwing the same amount into just 2 or 3 different stocks. Like I said, me personally, just VTI. I know a lot of people do the bonds markets that are a lot older. I personally don't. I just like to stick to the S&P 500 and the international. So to actually talk about the international and the S&P 500, we could talk a little more about Bogle's actual portfolio that he personally invests in, just to kind of show that keeping it simplistic is the way to go. So the first stock that he's invested in is the U.S. Total Stock Market Index Fund, or VTSAX, or VTI. Me personally, I'm in on VTI. This is just the Total Market International Fund, right? And it's basically just for everyone, especially, with this most recent crash. It's went up pretty well just because of the whole China thing and blah, 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 whatever. But number 2, he has the International Total Stock Market Index Fund, which is basically just the index fund version of VTI. That'll be VTA or VTIAX, sorry, and VXUS. And then he does have the U.S. Total Bond Market Index Fund. I know this is more of an older person kind of stock, or at least most people would agree on that. This is the VBTLX and or BND. This is basically just for bonds. If you don't know anything about bonds, I can make a video in the future, but I personally don't invest in bonds at the moment. Maybe down the road, I would look a little more into it. The returns on these aren't as good as, Vanguard's S&P 500 or, the international world stock. So I personally don't invest in it. Now, I do want to talk about one more thing before I wrap this video up. Basically just talking about how to get started. I know a lot of people might be newer into getting into stocks, especially having a younger audience. I know it's kind of complicated on where to start. It's a little more easier on just buying the stocks and selling the stocks, but no one really knows how to start. So the first thing you're going to want to obviously do is open some kind of brokerage account. This could be Vanguard, Fidelity, Schwab, or any other low-cost broker. It doesn't really matter. I personally use Vanguard, being that I am a Boglehead. It'd feel kind of dumb not to, just because I'm literally invested in the same way Bogle himself is. Might as well use his platform. But yeah, so just get yourself some kind of brokerage account set up. That way you can actually start buying the stocks. Now, the second thing you are going to want to do is have some kind of breakup of what you're going to buy. So this can be like 50%, S&P 500 and 20% VTI. What I mean is basically just break it up into whatever way you would like. Definitely going to make a video about that in the future for sure. There's a lot to talk about with that. Now, me personally, I'm not going to go too much into how I invest my money. It's really changing all the time, just because I do somewhat try to feel out the market when I invest. I invest the same amount, but like if I think VU is going to do a little better than VTI, or VTI is going to do a little better than VU, I do kind of pick my plays and invest a little more into one another. But not going to get super overcomplicated about that. Basically just figuring out what split you want to do. I actually made my video about my personal split, the 50-50 split, but that doesn't really go into the stocks in specific. It kind of just talks about me investing in stocks and then having money on the side for, a business. But yeah, so the third thing is just have it automate monthly contributions. I've talked about this a lot so far this video, is just make sure that you're putting some kind of amount in monthly, if not even weekly. It doesn't even matter. There's ways to set up reoccurring subscriptions. I think Vanguard has it, I'm pretty sure. I'm not sure if the other brokerages have it. I think Robinhood has it as well, if you want to try out Robinhood. But yeah, you don't have to automate it. It is a good idea, especially if you know you have the money coming in and you know it can be put in safely and not gonna, affect your, your finances and all that stuff. But yeah. So another thing I want to talk about is rebalancing once a year. So basically what this means is just kind of checking your portfolio at the end of the year and seeing, oh, maybe I have a little bit too much S&P, not enough VTI. Maybe I have a lot of bonds for whatever reason, right? Just kind of balancing out your portfolio to maintain its just overall diversity. Because like I said, you don't want to have like $2,000 in, S&P and then only have like $100 in VTI, just because obviously you're not going to be making a lot more, especially VTI or whatever does better. So just basically kind of sum that up is just rebalancing is, if you have 600 in the SP and you have 300 in the international, try to balance it out. Try to make sure it's either 500 both, or even just, re-up and just kind of make them both 600, whatever. Just balancing it out. That way, like I said, you're getting all the profit you can from the individual stocks. So the last thing I'll talk about before I do wrap this video, the most important thing in this video that I am going to talk about is do not touch the money. The whole point of this investment strategy is to not touch it. This is a long-term investment strategy. You will be holding this for, 30 to 40 to 50 to even 60 years in the future. I'm serious. Don't touch this at all. It's definitely a big advocate for the Roth IRA. I talked a little bit about that in another video. It's just a Roth IRA being you can't touch the money until you're 59 and a half. You get no tax on it. So it's literally taking advantage of a long-term investment strategy. But yeah, so just number one rule of all time for this strategy is do not touch it. But yeah, that's going to be it for this video, guys. If you do enjoy it, drop a like. If you want to see more like it, drop a sub. If you guys have any comments or concerns or whatever, leave them in the comments. I love responding to them as always. But yeah, that's going to be it. See you guys in the next one. Peace.